YieldMax released their, distributions for the Group C ETFs. I do have them noted here, just went away. Filtering based on Group C, though, for the single stock ETFs they have that pay on a monthly basis. Not covering some of the weekly ones that are more of like a multiple mutual fund of ETFs, should I say. But those ones, if you want to know, Salty was 55 cents, LFGY was 46 cents, Chippy 42 cents, GPTY 36 cents, RDTY was 29 cents, and then QDTY 17, almost 18 cents, SDTY 15 cents. YMAG and YMAX were both in the 13 cent range. And Ulti was at the standard 9.2 cents. We'll cover those shortly. I'll probably make another page for them, weeklies, because you don't want to compare weeklies to monthlies from a percentage basis, because of course they're paying roughly 4 times what the monthly one is. That said, for the monthly single stock ETFs by YieldMax in Group C, filtered based on the percent return. So this is the percent, the monthly distribution or dividend percent divided by the share price. But overall, Kony came in number one actually this month, 6.24%, and HOOY was pretty good too, over 5.59%. Like I always say, I always consider anything over 5% to be stellar for a monthly return. 4.58% was Carvana. D-Ray or DraftKings, one relatively new YieldMax ETF, 3.21%. AMDY was 3.14%, and everything else was under the 3% range. Airbnb or Airbnb, based on Airbnb, underlying equity, 2.45%. Similar PayPal, 2.42%. Netflix, 2.4%. And then the laggard Microsoft, only 1.82%. So those are the payouts for the Group C distributions. You can jump into those a little further. I just wanted to point those out. I'll probably jump into each one of these to see how they compare from a distribution rate over time. We'll start off with Kony. That was the top one this time. As you can see from the distributions over time, the overall ETF price of Kony, of course, has dropped significantly from 20. But as you can see, this time it was at 45 cents, which was better than last month's, but one of the lower distributions, bottom three. But that should be looked at differently. Over here, the stock was in the 20 plus range. So therefore, from a percentage basis, it was probably similar. I guess I don't have this on a percentage basis, but you can see earlier on when the ETF price was higher, they were paying the higher distribution. So right now, 45 cents. I don't think it's too bad from a percentage basis, and that I speak from a percentage basis because I'd assume someone that's new to the fund within the last month or 2 months, that's what they're getting. For the people that have been around the fund for longer, I guess I would go more to the price plus the cumulative distribution. So you can see some that bought in at 20. Yeah, I went from 20 down to 7 and change, but they've achieved a $31.48 cumulative distribution since then. So you've gotten over 150% of your money back already. In the YieldMax game, dividend game, distribution game, total return is the objective. That said, Kony it was above 40, so that would have been a 100% total return. Since then, it's definitely fallen, but it's still doing pretty good overall. So that's definitely a chart I like to look at. Then I guess jumping into PayPal, this one, of course, not a very big fund, probably not followed very well by people, but from a distribution per share, once again, we're on the lower end. That said, the PayPal share price is lower than it used to be, but 26 cents. That might be the lowest distribution. Yeah, I think it is the lowest distribution in its history. Average has been 58 cents, so about half. From a investor since inception date, we've turned $20 into just over $24 total return. So positive investment, but definitely not the best investment out there. But that's PayPal. Netflix, the next one I have. Just want to take a look at as I noted, I just want to take a look at the distributions to see how they're trending. Netflix has been pretty standard over the last 4 months. Came at 40 cents, been right around the 40 to 50 cent range recently, it seems. Overall, I think this one has been a pretty good investment overall. Turning $20 into, it looks like we're approaching almost $35. And then the initiation date on this was September of 23, or slightly before that, maybe August of 2023. So we're approaching it kind of a 2-year benchmark on this. And you're definitely up over, or total return getting close to 75% over a 2-year frame. So definitely a pretty good investment for those who jumped in. Not as good as clearly investing in the underlying equity of Netflix, because as you can see, you're doing quite a bit better. But for those who are looking for the income and willing to trade off some of the upside potentially for some income, not a bad return. Clearly, you're not going to keep up with the underlying equity and a massive bull market that we've had over the last 2 years. But not a bad return. And then for reinvested dividends, you're even doing better. You are up over 100%. You're turning $2,000 into $4,275. Jumping into Microsoft here quickly. Distribution, as I already noted, came in pretty low. It was 31 cents. I just want to Check that, I was right. Yeah, 31.6 cents. Basically the same as last month. One of the lower distributions, average 47 cents, so we're a bit low there. Let's see, just from a price plus cumulative distribution. So this one came out September, October 2023 as well. Turned $20. We're getting close to about a $30 payout total return. That'd be $10.74 in dividends, $18.20 in ETF price currently. That said, I guess a decent return. We're trying to get close to that 50% total return. But yeah, I guess from a total return perspective, though, we are at the highest we've ever been for Microsoft. So that's good to see. This hasn't been the best performing one, clearly, but for those looking for a pretty steady distribution with an ETF price that doesn't fluctuate wildly, the lowest looks like Microsoft's been is 16, and the highest has been 22, 23 range. So it's definitely stayed in a pretty good barrier, and it's paid a cumulative distribution over $10. So someone that invested in this back in the days already gotten 50% of their money back. We're looking to get more going forward. AMDY, this distribution is 24 cents. That one is also pretty low relative to the past. I should add an average line here. I do that on some of the graphs, but not all of them. Not sure why. Just the template didn't get carried forward clearly. And then from a price plus cumulative distribution, AMDY was actually performing quite well. Let's see, 1, 2, 3, 4, 5, about 5 months out from the inception date, giving you almost a 50% total return on your investment. But since then, it's been a pretty poor performer. But that said, the total return is up. So you're not down money from a total return perspective, assuming you invested in this back in kind of the October 2023 range. But the ETF price has fallen drastically, only to be saved somewhat by the $16.50 cumulative distribution. So for those looking forward, maybe they got better hopes. That said, a lot of these funds, if you're a new investor, don't look at the past. Really, if you got high hopes for AMD and the chip sector going forward, related to AI and whether AMD can compete with the likes of NVIDIA and some of the other entrants in the field, perhaps this is a good one going forward. It's only $7.77 per the last check. That said, people who did invest in it, not the best option, but you aren't down money. So I guess that's always a silver lining. Carvana, so this one hasn't been out as long. It's only paid, I guess it's added up here. It's paid 8 distributions so far. The recent one's the second lowest, but still $1.90. This one, of course, look at it a little differently because it came out at a $50 share price versus $20 for a lot of these YieldMax funds. And then for someone who's held it since the inception, so instead of starting out at a 20 total value, you'd have to start at 50. But you can see you've turned $50 into a total return approaching 65, so not too bad over the 8 or 9 month time frame thus far. HOOY is a big one that a lot of people have been following. It's, of course, based on Robinhood, the underlying equity. Lots of volatility in this one. Not around the longest. This is the 5th distribution. Distribution, I think I said, was the second best this week for the single stock ETFs that YieldMax does. It was $3.86. Once again, this was it came out at 50. I'll take that in terms, like I mentioned before, the other ones came out at 20. So from a percentage basis, can't look at them, or you can look at them the same, but from an overall amount, you can't necessarily compare apples to apples. But $3.84 was still good, second best either from a percentage basis based on the current share price, which is roughly 70. And then from a total return perspective, for those who invested at the start, you invested $50, you've gotten $24.43 back already in distributions, and your $50 investments turned into $69 investment. You're up on the cumulative you're up on the distribution, you're up on the ETF price, basically a perfect scenario for those looking to get in these funds. I've turned $50 into over $90 for a total return. The only negative one could maybe look at is they've taken a $5,000 investment and turned it into $9,351 or $9,743 if you would have reinvested your distributions into HOOY. But like I said, the only negative is if you would have invested in just HOOD, you're looking at $11,800. But if you could have predicted the rise of Robinhood, and that was your base case, I would argue that investing in the equity would have also been a terrible idea. They should have just bought call options. So that's actually one of the points I would argue with somebody that says that these funds are not good because they underperformed the underlying equity during a massive bull market over the last 2 years. Somebody would predict a massive bull market, the S&P more than doubles over a 3-year time frame. I would argue actually buying equity is not a good idea. You can go out and buy leaps or call options that would vastly outperform the equity. So whenever somebody makes an argument about what's the better option, they should first assume, or they should start with what their assumptions were over the time frame and look at all relative options that they could have invested in. But someone looking for some income, want to give up some upside for potential income on a monthly basis, this one's definitely been a very good investment. AMDY, ABNY, which of course is built on the Airbnb underlying equity. This was the lowest distribution since date, 24 cents, almost 25 cents a share. The average has been right around 50 cents, or about half. That said, you can see from the price plus cumulative distribution, this is one of the few YieldMax ETFs that on a total return basis, you are actually down since the inception date. Your $20 ETF is now like a $10 ETF, and it's only paid out $7.22 in distributions. So yeah, like I said, you can go to the YieldMax chart here. Once it loads here, if you have everything selected, you can do a filter based on total return percentage. And you can see there are a few that total return percentage are negative. So of course you got MRNI, AIYY, Morrow, SMCY, Airbnb, which we just covered. And then Group C, just came out, it's down slightly. XOMO's been around for a while, and it's basically a flat investment since then. So the top or the bottom 7 here are definitely bad investments. I guess that's it. You could compare to the underlying equity. I imagine that's also been not the best investment either. But overall, some of these definitely have underperformed. What did I say? There's 7, but a vast majority are definitely in the positive area. Overall, if you would probably compare to the underlying equities, I would say this is a more contained distribution. The highs aren't as high, the lows aren't as low. And for the most part, a lot of these are positive. But yeah, I guess that was Airbnb, one of the few negative, YieldMax ETFs since the inception date. Jumping into the last one, DRAY. So I guess I just added this. This is a somewhat new ETF. It's, of course, I believe it's built on DraftKings, right? I believe that's the case. Yeah, definitely. Yeah, it's based on DraftKings. I thought so. I just didn't want to misspeak. But yeah, this one's only been around for a little bit. It's paid its second distribution. The distribution was $2.19 last month, $1.56 this month. Comes an average of $1.87. And then I said, I guess like a middle of the pack, if I remember right, from the Group C, which I'll just pull up again quick. So Group C here, and then filter based on percent. D-Ray's in that 3% range. Middle of the pack, not too bad. As noted, when I'm looking at these funds, of course, you can't expect the same thing for every fund because clearly Coinbase gets more implied volatility, or Coinbase and HOOD get more implied volatility than Microsoft and PayPal. But in general, I like to think, man, if you can get like 5% plus, that's like top-notch category. So I put like Kony and Hui in there. 3 to 5% is, I'd say, kind of standard, good, not like exceptional, but definitely good. So Carvana, DRAY, AMDY. Anything under 3% on an annualized basis, you take 2% on a month times 12, you get 24%. So definitely from a yielding perspective, it's pretty good. But given the capped upside, I would say if you're under 3%, or maybe I should even say probably 2%, anything that's under 2%, so like Microsoft in this case, looking for a little bit more than that based on what you're giving up in upside. So that's just my opinion and from looking at these funds. But of course, like Microsoft, clearly what could be bad this month might be good in another month, particularly if you got a month that has earnings in it, you got a little bit more implied volatility. So you can see like recently Microsoft, like back in May, 54 cents, that's nearly double. So that would have taken, from a percentage basis, that would have increased it substantially. So what can be bad and what might be good in another month? But I guess just look at it overall and assess it according to whatever your parameters are. Of course, assessing all of these instruments, I guess it's what's your base case. Your base case, like the 10-year yield is, or what the CD rate you can get. CD probably going to be a very good comparison because you got virtually no risk. Whereas these, you definitely have risk. So you take something with some risk, what the percentage return you can get is, and then compare accordingly to the YieldMax return. But yeah, so back to DRAY, price plus the cumulative distribution. We are up slightly. We were up a little bit more. I think you're actually down on the ETF, but with the cumulative dividend of $3.76, it puts you in positive territory for the 2 or 3 month time frame that you've had it so far. So let's break down of Group C. You can see if you go to Group C here, just my summary page, I had the ticker here with all the Group C items. And then I also got Group C. I think I need to add DRAY to this. I don't have that, but I try to list what the YieldMax ETF is trading at and then what the underlying equity is trading at. So you can kind of see them back to back. For the most part, you would assume they're trading about the same, unless they've been on a big upward run lately and they've like gone past some of the strike prices that they've sold. In such a case, I would expect the YieldMax fund to be slightly underperforming the underlying equity. If that's not the case, sometimes the YieldMax fund can definitely overperform because you're getting that premium up front. So if the stock goes down over the time frame, you're collecting that equity or that options premium, and it's expected to expire worthless over that time frame, the YieldMax fund should slightly outperform. But overall, you can see most of them, for the most part, are trading similar. The ones that are down for the underlying equity are also down on the YieldMax fund. And likewise, the ones that are up are also up in the YieldMax fund. Here's 2 examples: PayPal and Netflix up 1.5%, 2%. You can see the underlying or the YieldMax fund slightly underperforming, that would clearly be an assumption that we've gone past some of the strikes that we've sold. So therefore, we get capped on our upside for at least a portion of the investment, therefore given the underperformance relatively to the underlying equity. So yeah, Microsoft, AMDY are all kind of trading very similar as one would expect. But I'll just jump in to show the example of Netflix. So Netflix up 2% today, underlying equity down or up 1.3% for the YieldMax fund. So if you want to jump over to Netflix and go to the in-depth view, I do show the positioning of this fund. So you can see Netflix is 12.24 right now. So 12.24, we're about, this morning it looks like it was about 12.15. We are definitely up pretty good, 2% or $24. So close to this 125 mark. So you can see we sold calls at 1200, 1210, 1212. So we've blown by those. So clearly as the stock continues to go up, for the amount of contracts that we have that we've sold, limited our upside for these total contracts here. That said, this one is structured interesting because we sold calls down here, but we bought calls, I guess, between 1225 and 1237.50. So as Netflix stock keeps rising, we will get rid of that capped upside for this many contracts once we go past 1225, and then 1232, and then 1237 respectively. But then what's interesting is then you got some more sold at 1240 to 1242.50. So once again, if it goes higher than that, and this would be by the end of the week, upside will once again be capped for a portion of the investment, only to then capture it back if it goes above 1272.50 by the end of the week. The synthetic for Netflix is where you have that, you basically create the synthetic by, of course, buying the call, selling the put. It's at 1260, so it basically gives you the same exposure as owning several shares of the underlying stock. That is at 1260. So Netflix, and if you look at it from a fund makeup perspective, then the fund is worth, as of last check, $16.65. It has $17.39 per share of cash. However, the synthetic value right now, because the stock's currently trading less than that synthetic, is a negative 68 cents on the fund. And the weekly contracts we have sold act as a negative 7-cent impact on the fund. But as far as what it's doing from a synthetic position, I just showed you all the calls that they have bought and sold. If I look at the actual numbers, they have 1,375 contracts that they have sold, but they also have the exact number 1,375 contracts that they have bought, given like 100% credit spread, or from a strategy perspective, they're using the credit spread 100% of the time. I consider that kind of like an insured position. But yeah, so basically what I'm saying is, what was that? It was 1,375. So you should be able to add up anything that's below. If you add up those contracts, those should add up to negative or 1,375. If you add up these contracts. So in this case, it says shares. Shares technically means contracts. If you add those up, those should also equal to 1,375. But yeah, that's how Netflix is structured and why currently it's underperforming the underlying equity, because we capped our upside on slightly more than half the investment. So clearly it makes sense to underperform by about a half. It probably would be exactly half, but we're getting close to these contracts that we bought. So the value of these are starting to go up because the stock price is approaching the strike price. And in this case, looks like Netflix just went over the 1225. So this one's now positive. The upside has been uncapped for 276 of the contracts. So take 276 divided by the 1375, and that percentage of the investment is now uncapped and will continue to gain as the underlying equity gains. But anyway, yeah, that's just some deep dive into Netflix there quick. Any of the ones where I have the in-depth button, just as a note. So if I got the in-depth button, maybe I should first stop. If you just go to the Netflix page, I basically just look at the Netflix, NFLY, the YieldMax ticker. I like to look at it from a comparative perspective, how it's doing versus the underlying equity, and then the reinvested dividends or non-reinvested dividends, how those two kind of different thought processes, or how one employs the dividend or distribution going forward, how that makes a difference in what your total return is. And I like to track what the distribution has been over time. I like to track the total return. I like to split it between what the cumulative dividend is and what the current ETF price is, so you see the breakdown of the total return over time. This all VARs button is just all the kind of variables I've already noted, but they're all on one chart. So blue here is the distributions over time. The yellow here is cumulative dividend. The blue here is the ETF price. And then the green is, of course, total return. The all VARs total return does assume no reinvested dividends. So you can see 3406. Yeah. all of ours. Yeah. And I just as a note, I always assume that somebody doing this, I assume you start off with 100 shares of NFLY at $20 a share. So most of these are assuming like a 2,000 base case underlying investment. You, of course, can take that and multiply it by however many shares you bought. But that's the base case, I assume. If it came out at $50 a share, which would be the case for HOOY, for example, that one, of course, assumes a starting value of 5,000. So instead of the initial point, it would be 50 instead of 20. And a lot of times my dots don't start till the first distribution actually comes in. So there definitely was some movement, but you can assume all these lines, at least up here, go back to 50 for the first data point. And then finally, just the underlying equity price. So that, of course, is a good thing to keep in mind when you're invested in the individual YieldMax funds. But if you do click the in-depth button, I have their positioning. So if you go to the YieldMax website, of course, you can download the actual YieldMax holdings. And you get an Excel spreadsheet. A lot of people probably know what that looks like if you've looked at it. I don't find that to be very intuitive or very easily digestible just by looking at it. Maybe some people do. That's fine. So I like to do is I like to take it and put it into a visual. And I basically can see where their synthetic is in the red line, where the stock price roughly is. And then everything below the zero are calls that they have sold at the specific strike prices. And anything above the x-axis is calls that they have bought. So I can see how this fund I would expect it to do based on where the stock price goes. For the next tab, I do have the previous iteration. This is their positioning basically today, and this was their positioning yesterday. So a lot of times this won't change, but if there's some movement in how they're positioned from day to day, you will see differences between these tabs. So that's just something I like to look at. The fund makeup. So I got this as the total ETF, all the money, how much cash the ETF has, what the market cap of the ETF is, how much money they got in their synthetic, and then how much money they basically made from selling their contracts. So you can see, like in this case for HOOY, I guess their total contracts right now, it's not how much they took in, it's how much they're worth right now. So if they were to close their other contracts, it cost them $2.2 million. And if they go to zero and expire worthless, that's $2.2 million for the fund that they don't have to buy back. Expired worthless, you keep that option premium. Their synthetic, you can see it's currently at $25.8 million. Yeah, I guess that's just how much their synthetic is. I find this somewhat useless because I don't own the entire ETF. I own shares. So on a per share basis, I basically just take those numbers and divide it by the shares outstanding to get the per share metrics. And then the final tab, I just want to this is how they're using their collateral. So these funds, of course, buy calls, sell puts to create a position in the stock virtually. They can use this as collateral then to sell other calls against. So if you buy a call if the stock's trading somewhere around 100, if you buy a call at 100, sell the put at 100, you basically get the exposure like having 100 shares of the stock. So you can then use that collateral actually to sell like the 105 call against. So even if you don't own the shares, you own a call option that acts as collateral that you can use to sell a call against. So hopefully that's not too complicated. But basically what this says is based on their synthetic position, they can sell 20,380 calls. Right? They got that much capacity. You can see here, I got the remaining capacity. What this means is they've sold 20,380 calls. So they've sold everything they can based on what their collateral allows them to. Of the 20,380 calls that they sold, they also bought 18,130 calls. So that would be employing a credit spread where you sell a call at a lower strike price, but then buy one at a higher strike price. Of course, this ensures that if the stock goes on a massive run higher, you don't get capped out on all the upside. So you buy it at a higher strike price to be like, okay, if I sell a call at 5% upside, but then I buy the call at 10% upside, that means if the stock goes up 20%, I get capped out from the 5 to 10%, but from the 10% on to 20%, I do capture all that upside once again. So that's the approach I actually like. In this case, you can see they got 89% credit spreads, and then that would leave them like 11% where they don't have a credit spread. They just have a call sold, no call bought. I do the credit spread method overall. You give up a little bit of premium that you take in on a weekly basis, but you get that massive exposure if a stock goes on a big run. So I've always liked this method. I know there's some different opinions on it, but I tend to like it. But yeah, that's an overview of the chart. And then finally, the thing that I guess I was thinking, so this fund makeup per share, I like this chart because it tells you the ETF price is made up of how much cash they have and then what the relative values of the contracts they have sold and their synthetic is. So if you add these three components together, you get what the ETF price is trading at. I like this, but then I was thinking to myself, I want to see how this trends over time. So like day by day, how does it trend? If you want to see that, you basically go down to here and then this shows you. So these are the different values. This is the ETF price, blue's your cash price, your cash holdings. This red's how your synthetics traded over time. And then finally, these yellow marks should all be negative because they represent the negative value that selling the call option upside is currently worth as far as the fund from today's date or the date of reporting. So you can see here, that's like negative 65 cents. You got negative 65 cents. So these values should report or should reconcile with the far most right points on the graph. So you can see a synthetic value of $7.45, $7.45. So these are how they trended over time. You can see like HOY from 9.8 to 9.9, we did have a big jump in the stock price. So therefore you had the synthetic jump a lot. This didn't necessarily, I guess, so 9.8 to 9.9. So I guess we had a lot of things going on. Their cash went down, given their synthetic went up a lot, but the other contracts that they sold didn't really move much. Based on what I'm seeing here is the synthetic went up, so your synthetic position went up. We actually used some cash, so $65.28 down to $62.40 to restructure these contracts down here. So they were, because I assume that when this went up, these contracts should have probably went down more negative. But we used some cash to restructure them so they weren't worth as a negative amount, a smaller relative negative amount. But overall, the impact caused the ETF price to go from 62 up to nearly 68. So that's the time series approach of reading these. And I like to look at it. Maybe it's a lot of information to people. But on distribution dates, you can see, you usually see the cash position decline, just basically meaning that they took their cash and paid it out to investors, which we all like. But, and then over the week, assuming there's not a huge move in the stock, you would assume that this cash position will slowly go higher as they sell those weekly call options. So you can see like that's the trend I would expect to see. You're going from $63.06 up to $65.28. Assuming you're not spending your cash to either restructure how your synthetic set up or how the weekly call options you have sold are set up. But that's another chart. That's a lot for today. I'll end it there, but thanks for tuning in.